Okay, so this is the work on market entry. One thing I'll say about this chapter is some really nice examples in the book. So I'll try and be relatively brief and just go over a few of the major points and try and give one or two of my own examples. So this is all about the market entry decision, how to select, and this is what you're kind of doing for your project, how to select the country you're moving into, how big you make your entry. We talked about how Target moved into Canada, and they kind of moved in half-heartedly. They took over somebody else's stores. They didn't necessarily have the scale they needed for an efficient supply chain. So that's kind of important. The mode of entry, are we going to be wholly owned? Are we going to mitigate some of our risk with the joint venture? Are we going to do franchising? How to time your entry. Entry is not, it's not very good to enter a market at the beginning of a huge recession, and how to kind of plan your marketing campaign in order to optimize your market entry. So let's just think about a few different types of companies. And this is like the Burj Al Arab, which kind of bills itself as the only 7-star hotel in Dubai. And one of the things to think in market entry is how much it's going to cost you to enter the market. So hotel companies tend to have a large amount of upfront capital costs in order to invest in the market. So quite often this is done by joint ventures with local partners who know the market. And in that way, it mitigates a little bit of risk from the investment. Now, think a little bit about car manufacturers. It's very similar. If I invest a huge amount of money in say a Ford manufacturing plant, it's very unlikely that this is going to be much use to anybody else, even another car company, because they use different platforms. So again, car companies will build strategic alliances with other manufacturers. They'll try and share development costs, as in the Renault-Nissan alliance. But at the same time, if I'm a car manufacturer, this is a huge investment. And I found this for the sale of entry. I thought this was kind of quite interesting. And this is kind of the car sales per capita. You can see it's very cyclical. And it's a little bit out of date. This was like 2008. This is when the big US auto manufacturers needed to be rescued. And you can see that, again, if I want to move into a market and I move into a market here, then this is not a very good decision at all. I'm probably not going to be successful. But if I kind of move in just as the market is recovering, then I'm liable to be successful. Okay, so how do we select the countries? Well, we have to decide, and this is almost relating back to market research, what's important to us. Do we want high GDP per capita? Do you want an educated population? Do we want strong rule of law and no corruption? So we kind of decide what's important to us. We determine how important these indicators are. We then rate the countries, and we can compute some overall score for each country. Now, I'm going to do a little example, and this is actually the one little calculation, and I'm going to show you two different ways of doing this. The first is called satisficing, and that's where we have certain cutoff points for each attribute, and we decide, okay, we're not going to move into a country with above a certain level of corruption. We're not going to move into a country with, say, less than $20,000 per year. We just kind of cross off the countries. And the other one is we kind of do a weighted sum and we calculate an overall score for each country. So let's kind of go ahead to the exercises. I'll just stop the video. Okay, so we have this little scenario here where I've just kind of got, and here you're like working for an American fashion boutique. You decide to basically use a cutoff strategy, and you decide you want countries with a GDP greater than 40,000, a population greater than 5 million, corruption, and here we say corruption high is good. So we've got the corruption indices. We want a relatively masculine culture, because if you remember from chapter 4, masculine cultures buy more of these high-end fashion goods. So which countries would you actually consider? So let's just kind of go through. I've got my red pen here. So first we want a GDP per capita greater than 40,000. So we're going to have to remove, okay, maybe I shouldn't have gone all, we're going to have to remove Italy. What else do we remove? We'd have to remove Germany. Okay, so now we want masculinity greater than 50. So we remove France. We remove the Netherlands. We remove Sweden. And we remove Denmark. Basically all the low masculinity Scandinavian countries. We want corruption greater than 5. Well, actually, the only country corruption less than 5 is Italy, and we've already removed that. So that's pretty much our kind of set of countries. And we've got the population greater than 5 million, GDP greater than 40,000, corruption index greater than 5, and a masculinity score greater than 50. So we're left with Belgium, Austria, UK, and Ireland. Okay, so the next one we're going to do is we're going to do the actual weighted sum. Okay, so here we consider a weighted sum score for each of the countries. You're choosing a weight of 2 per GDP per capita, 1 for population, 1 for corruption, 1 for competitiveness, and 2 for masculinity. Now notice here we've ranked the attributes, because otherwise GDP would and things like population would absolutely dominate things like corruption on a scale of 1 to 10. Another thing we could do is we could do some, and I'm not going to do anything like that because we don't have the stats prerequisite, but if you've taken stats 1 or 2, we could actually standardize these values. We could subtract the mean, divide by the standard deviation, but we're not going to do that. So we've just kind of ranked them in order, but with the highest ranking being good. So here you see Ireland has the highest GDP per capita, followed by Denmark. Germany has the highest population, followed by France. So let's just see, and what we've got. We've got 2 for GDP. We're weighting GDP per capita 2, population 1, corruption 1, competitiveness 1, and masculinity 2. So we kind of have our score for Italy. We've got the 2 for GDP, but Italy's only rated 1. You see here, so that's 2 times 1. We've got a 1 for population, and Italy has a population of 8. Then we've got a 1 for corruption, and Italy is just got the worst corruption score. And we've got a 1 for competitiveness, and again, Italy has the lowest competitiveness score. And then we have a 2 for masculinity, because that's a really important attribute for us, and Italy has a 9. So we get 2 plus 8 plus 1 plus 1 plus 18, and that's 26, 28 equals 30. And I'm not going to do all the countries because we'd spend like 30 minutes on it, but I will include this in the revision guide. Okay, so we've kind of worked out, how do we choose a country? And this is kind of this diagram's a little bit complicated, so I'm not going to test you on this, but it's kind of this process of you start off. Do we move abroad? Then we say, why do we move abroad? We do our country screening. Then we do our primary and secondary market research. We choose our marketing entry mode. Once we've chosen that, we have a marketing plan. We enter we see if it's the right time to enter the market. We're in recession. We enter the market, and then we evaluate our performance. Okay. So scale of entry, and I'll just talk about a few little examples. So a large scale of entry may, give us automatic kind of advantages. We've got automatic economies of scales. But sometimes it can, if it goes wrong, then obviously we're taking more risk. And, existing people, if suddenly I come in as Walmart and, for example, I buy Asda in the UK, as Walmart did, then suddenly I'm the major competitor. So when Walmart came into the UK supermarkets almost started a price war to try and, attack attack Walmart before it kind of got too comfortable. But there, you know, there's trade-offs here. Walmart moved into Germany, and they probably didn't have the economies of scale. A little bit like Target in Canada, they bought like an existing company that really didn't fit the Walmart brand. So it's something of a trade-off. And a nice little example actually is the supermarket Lidl. Lidl is a discounter, a little bit like Aldi, very much the same business model. They've come from Germany. They've been very successful in the UK. And you see here, what's interesting is they've built their own stores. They're kind of greenfield sites with this kind of the Lidl brand. And they've kind of incrementally built their, you know, built their footprint in the US. They're just about to, they build 50 stores, they build another 50 stores, and they're just about to add another 50 stores. So this is they're kind of building up cautiously. Now the disadvantage is they might lack economies of scale at the initial period. One interesting thing is when this article is a nice article, it's saying, hey, when Lidl actually moved into new markets, you know, they were competing with Trader Joe's, their competitors kind of cut prices to compete with Lidl's. So again, Lidl's might lack economies of scale, but by moving carefully, they can slowly build up their brand in the US. And, you know, they're making a lot of money in Europe, so they can probably cross-subsidize their operations from Europe. So that's the example of Lidl's. Okay, so choosing our mode of entry. So now we're going to talk a little bit about, you know, different modes of entry and different kind of ways of entering the market. And we're evaluating them in certain ways. The size of the market. You know, why does everybody want to be in China? Well, it's got 1 billion people with a big middle class. What's the risk of the market? You know, if I have like Venezuela, I have a government that's liable to nationalize my assets, that's a very high risk. It may be that I have an unstable currency like Zimbabwe, so I move in and the currency, I buy my stuff in US dollars and then the currency crashes, and suddenly I can't make enough money in US dollars to actually justify moving into the market. You know, what are the government regulations like? If I was to move an alcohol company into a strict Islamic country like Saudi Arabia, then that would probably not work because of government regulations. What's the competitive environment? You know, Walmart moved into the UK with Asda, but they maybe didn't realize quite how competitive the market is. They were competing with the UK supermarkets along with these German discounters, Aldi and Lidl's. You know, what's the cultural difference? If I'm moving into Canada or Australia, I have to adapt my product range, but the cultures are relatively similar. And what's my infrastructure? You know, again, we talked about Target's supply chain problems in a country like Canada, which does have good infrastructure. Imagine if I'm a retailer, what supply chain problems I can have if I have very poor infrastructure. So these are kind of how we evaluate, and we've already kind of done this, how we evaluate the different markets. So here's just, I'm going to give a few more examples in a minute, but here's just an example of categorizing countries on 2 dimensions. So it's a little bit like from Chapter 7, Market Segmentation. It's the opportunity of the market and how risky the market is. So you see that Vietnam and Myanmar, and I think this is out of date, I would rank, you know, Vietnam has a relatively open, Western-friendly government, and it's grown. So I would put probably Vietnam, at least in this middle quadrant here. But if you have an unstable country, not so good economy, maybe like Myanmar, then that's probably not my first country I'm going to move into. And this was for kind of a company called Heinkel moving into the Asia Pacific. And again, you see Japan, very good opportunity, low business risk. Australia, only population of 30 million, low bit, but very, you know, stable democracy, low opportunity, mid-range risk. And by just categorizing the country, a bit like, you know, segmentation, we can begin to guess which countries we want to actually be interested in moving in. Okay, so this was if we did it in class. I kind of like, this was just a bit of fun. We're obviously not doing it in class. But this is Hugo Chavez, and he might, if you move into Venezuela, he might actually nationalize some of your businesses. This was actually, some countries in Europe have much stronger unions than in the US. Walmart had trouble in Germany because, you know, German employees like to drink beer at work or have beer for breakfast, and they don't like to be drug tested. And some of the labour practices in the US would not actually in work in Germany. This is kind of the competitive environment. You know, if I'm moving beer into Mexico, I've got this whole range of very strong competition, particularly from, for example, Modelo Group. And this was supposed to be currency risk. We were actually taught, it's hard to do this not on in class, but this was actually about Zimbabwe. And this fact we have hyperinflation and the currency kind of depreciating rapidly, which if you move all your money into the local currency, suddenly you have a lot less US dollars than you had before. So here's a nice example for infrastructure. So you've talked about how India and China have really grown, these billion-dollar, billions of, each have over 1 billion people, each have rapidly growing economies, but India's infrastructure is a little bit behind China. So this is an example of a rush hour in India. Now, India is beginning to build freeways, it's beginning to build up its public transportation, but it's still a major issue for things like logistics and, just general kind of quality of life. Okay, so this is kind of similar to the one before. I won't really go too much into it. But this is where we have, we have actually already got our kind of categorized markets. We've got established, maturing, growth markets, emerging markets, and platform markets, which I'll talk about in a minute. And the idea is each of these markets would actually, you would actually have different modes of entry depending on the reward and the risk. But I'll just talk a little bit about these types of markets. So we have platform countries. Now, the idea of a platform country is it enables you to move cheaply into a region, but also begin to understand the region, almost like a listening post. So I said Singapore and Hong Kong. Hong Kong with political issues might not be the best platform market at the moment, but Singapore, I lived in Singapore working for Dow Jones for about 1.5 years. Very westernized culture, not a full democracy, but English speaking. That's the kind of Singaporean dialect of English called Singlish. Has extremely good public transportation, and it has very low corporate tax. So a lot of corporate headquarters for Asia, because English speaking, because it's got good governance, good rule of law, a lot of corporate headquarters actually moved there. And it's interesting, a lot of pharmaceutical companies moved there because they were having trouble with animal testing, people protesting them in Europe. And again, not quite being the full democracy Singapore, but still having a very strong rule of law, it was a lot safer for these companies to be in Singapore than in certain places in Europe. So this is why, Singapore is often called Asia for beginners. The good infrastructure, most people speak English, good public transportation, just very easy to do things in Singapore. So how do we choose, other things, choosing our mode of entry? What's my objectives? If I'm Microsoft, obviously I want to sell all the operating systems in a certain country. But a small software company, I might just be aiming like a niche. I want to sell software to universities. And again, if I'm a retailer, IKEA, I want to dominate the market in the country. If I'm a small furniture manufacturer, I'd be happy just like exporting a little bit of my furniture, maybe to expats. Say I'm a Midwestern furniture manufacturer. Maybe there's just a few expats in China who want traditional Midwestern furniture. So I'll just kind of export there. I don't really care about dominating the Chinese market. It's far too risky for me. And again, going into biotech, most biotech companies actually license products rather than produce them. They want their expertise to be in the PhDs in the drug development process. So they will generally go in licensing. But a generic drug manufacturer, it's how much, a generic drug is one where the copyright has run out, so the patents run out. So it's literally we want to produce as much as cheaply as possible. So again, we want to build factories either wholly owned or joint ventures. How much control do we want? If I have something like, a drug manufacturer and I allow the manufacturing to be done by somebody else and there's quality issues, that's going to impact very badly on me. If I have a retailer, like, say, for example, McDonald's, and I have a franchise and the franchise is in charge of the daily operations, maybe they'll do something that will hurt my brand. Maybe they will would have a racist advert, or maybe they would actually have very poor quality products, or maybe they will have worker issues and they'll have strikes. So there's all sorts of things. These things I have little control of because that company is in charge of the McDonald's brand in the US. And also, what can we do? As I said, the biotech company has no experience with manufacturing, so it's not very good at manufacturing. A drug manufacturer, it's not going to be developing new drugs. So, if we don't have the resources, say, for example, to start building factories in a certain country, if our advantages in technology, then we're probably going to lead us to a certain mode of entry. And, how this is just general common sense, just what degree of flexibility do I have, in entering a new market? Can I afford to take a loss for the next 5 years, or do I need to be immediately profitable for my shareholders? Okay, so we're just going to talk, and we're just going to kind of go through I'm going to talk about franchising in a minute. We're just kind of go through some different modes of entry, and I'll talk a little bit about each mode of entry.